Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. We love talking about small caps on this podcast. There's some really interesting companies doing some really interesting things. Today, I wanted to look at a piece of research from an Australian fund manager suggesting that while small cap stocks have significantly underperformed large companies in recent times, many quality small caps actually have superior earnings profiles to some of the larger companies. Maybe some of those higher quality companies in that small cap index have been oversold. Remember, this is general information only, and you should seek professional advice before making any investment decision. ICE investors actively manage Australian equities in that small cap area. Callum Burns is the managing director and lead portfolio manager of the ICE fund. Callum, welcome to Fear and Greed.
Oh, thank you for having me, Sean.
Now, I mentioned that you focus on the small cap end and particularly on franchise companies with a sustainable competitive edge. What does that actually mean?
The franchise term is, well worth defining. Some people think it's Kentucky Fried Chicken or something of that nature, and it can include. But a franchise is actually a business which has an economic moat around it, which is a very strong business, and it makes it difficult, that moat, if you like, makes it difficult for competitors to come in and take the company's revenues.
Oh, okay, so I get that. So the idea is that because they're a franchise model, be it marketing, be it processes, that type of thing, they have that in place. Therefore, that is a competitive advantage.
That is true, and what you're talking about, franchises are part of the universe, but really a franchise, is a business with an economic moat, is anything that has assets that are difficult to replicate and stick to customers.
Yep.
So it can be a toll road, it can be a business with a strong brand.
Yeah, much broader. Yep. Okay, so how do you go about finding them?
Well, we just work really hard. So we've got a very strong team, and we burn a lot of shoe leather, and we talk to a lot of companies. We talked about 500 a year, and we reject most of the companies that we see as investment candidates. But we're just, again, trawling through as many things as we can, talking to companies, talking to competitors, doing research in order to find those companies that have got the assets that are difficult to replicate and the sticky customers.
Okay, so this research that you've done recently, Callum, the idea that the small cap world is definitely a place of disparate companies, many different types and sizes and shapes. And because it's generally been sold off, there's actually some opportunity there now because some pretty high quality earnings in some of those companies.
Yeah, that's true. When investors and potential investors look at small caps, they sort of see it as a bit of a one size fits all. In actual fact, something that's not very well known or recognised, that within the small cap market, there's almost actually two quite different markets. And that's what the research that the team did at ICE Investors, that's what that revealed.
So just tell me a bit more about that. What are those two sides?
Well, when people look at the small caps, they just tend to think of it as, very early development because of its name and, sometimes, quite risky companies. In actual fact, there's almost two halves. So when we went through and did some work where we defined companies in terms of their franchise quality, into fifths. So, really strong franchises, good franchises, the average company, the below average company, and sort of, loss makers, challenge companies. And what we found is in the small industrials, nearly half was in that franchise and strong franchise group. And, they're very strong companies. The other half, of course, were not so good and not so strong. But when you look at them, and we can talk later about this, when you look at the profit performances, those two different halves, they're really starkly different.
Okay, so let's talk about, firstly, the quality of profits. The quality of the company I kind of get, but you also want quality profits, don't you?
You do. But I guess at the end of the day, usually, true in 90% of cases, a quality company delivers quality profits.
Okay. So can you give some examples perhaps on either way, ones that aren't so good, but particularly the ones that you like, that you think, okay, they're kind of been thrown into the small caps index, but there's a bit more to it than that?
Yeah, well, what I might do is just focus on the strong ones, if that's okay, in order to preserve relationships with companies. So if we look at those in that very strong franchise area, classic examples are Auckland Airport, Chorus Limited, there are a couple of New Zealand companies, Macquarie Technology, Hub24, which is a platform business. There's a very strong and rich array of very strong franchises sitting there in the small industrials. That's the very highest group. And then when you look at sort of, the solid franchises, there's companies like Breville, which I'm sure many of your listeners would know. There's Bapcor, which is an auto parts distribution company. GUD is another auto parts distribution company. Another one, for example, Hansen Technologies, which does IT billing systems for utility companies. There are some examples of the sorts of companies that you do see. And just because they're smaller doesn't mean they're not strong and good businesses. I do think in the Australian context, there's often a bit of confusion between big and quality. Something can be smaller and still be high quality, and something can be big and not be of particularly high quality.
It's interesting. I don't know Chorus, to be honest, but the others that you mentioned, mostly they're fairly established companies too. I suppose they are small cap because they're not top 50, but they're pretty solid businesses and some of them have been around for a long time.
Yeah, that's absolutely true. And I think the small caps is a bit of a misnomer. Like the largest small cap is, a multi-billion-dollar company, believe it or not. And in our fund, the median market cap is about $1 billion. So when you get to that, it's something of a sweet spot. When you go and see the company, there's lots of trucks, lots of people, lots of computers, but it's not too hard to imagine the company being, double the size in 5, 6, 7 years. So, that's something of a sweet spot for us and in the market, we believe.
Stay with me, Callum. We'll be back in a minute. I'm speaking to Callum Burns, Managing Director and Lead Portfolio Manager of the ICE Fund. Okay, so what's ahead for small caps? Because we finished 2023 knowing full well what happened with the small cap index broadly, vis-a-vis against the large caps. You've just named a bunch of companies there which you think could well outperform, I'm presuming. Do you think the whole small cap index will be dragged up, or do you think some of these quality companies with great franchises will significantly outperform?
Well, we think the latter, because when you actually break up the forecast earnings growth, remember I was talking about those 5 categories, which are in effect the good half and the not so good half.
Yep.
When you look for, financial year 24, the earnings growth in the good half is strong and positive. To give you a feel for it, the highest category, believe it or not, forecast to grow earnings by about 25% this coming financial year. And the solid group are forecast to grow earnings by about 10% over this coming year. That's really strong. But when you look at the not so good half, earnings are actually expected to shrink. So yes, it's logical that share prices follow earnings, and the good half, which when people do analysis often gets mixed in with the bad half. That's why we think there's been some erroneous conclusions drawn. We think the good half can do really well. The not so good half we think will continue to remain challenged.
Tell me about Breville. And I'm going to pick on that one because that has been one of my favourite stocks for a long time, mostly because I like toasted sandwiches and there's nothing more sophisticated than that. But I have followed Breville for a while and it's been, amid the small caps, it actually has been something of a star. And you're saying you think it'll still go that way?
Well, we think Breville is a very good company. The management are excellent, but is not one that we currently own.
Right.
The reason is that we're seeing companies at, if you like, a cheaper valuation or cheaper price. So, whilst their quality might be, say, the same as Breville, we think we can get a higher return from them. So Breville is well held and well understood. We think there's, better opportunities in some other companies.
Yeah, okay. So what about the risks? So all this is great. What are the biggest risks to these companies that you're thinking about? Is it macroeconomics still in terms of a recession or at least a significant downturn? Are we past the supply chain issues? Is it competition? What are the things that you're most worried about?
Well, the things we do is we focus on the long term. And when you get a good franchise and you buy it at the right price, then you tend to do well over time. So things like supply chain issues, they come and then they go. But if you can buy a company with an economic moat and not fall in love with it and make sure you're paying the right price, you can do very well over extended timeframes, including many years. So, we think the companies we've got in the fund are poised to do really well. They've got assets to replicate. The customers are sticky. They're gaining market share. And when we've gone through tough periods like we've just gone, many of them have actually increased their shares. Weaker competitors have fallen by the wayside. So when you look at what's happening in the actual businesses, you look at that and you say, well, that looks, we think, very strong. And yet when you look at share prices of small caps overall, they're down over 20% compared to large caps over the past couple of years. And we just think there's a disconnect there. And we believe that's because investors are perhaps looking or focusing on more on the not so good half, whereas the sort of hidden gems under that, the good half, are actually performing very well. For example, people look at small caps and they often think that, there's so much risk here. But when you look at the good half, this surprises many people. The actual debt levels in that good half are actually less than what you see in the top 100. And the actual EBIT margins or the profit margins are actually higher in the good half than you see in the top 100. So again, I hope you're sort of getting this picture I'm giving of the baby being thrown out of the bathwater and perceptions not always being accurate.
Yeah, Callum, very, very interesting. I'm going to have to go and look at some of these stocks, I think. Thank you very much for talking to Fear and Greed.
It's a pleasure. Thank you for having me.
That was Callum Burns, Managing Director and Lead Portfolio Manager of the ICE Fund. That's ICE, ICE Fund. This is the Fear and Greed business interview. Remember, this is general information only and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.